8 states. That is how many will still tax your Social Security check in 2026. And if you're retired in one of them, the IRS and your state government are pulling up to $4,800 a year out of your pocket, money you were never supposed to lose. I'm going to name all 8. I'm going to show you exactly how much each one takes. And I am going to show you the 3 legal moves that can cut your state Social Security tax to 0, even if you never leave your house. And if you are sitting there thinking, I don't live in one of those 8 states, this doesn't apply to me, hold on. Because even if your state doesn't touch your Social Security, there are 4 states that tax your 401k, withdrawals, and pension income so aggressively they cost retirees more than Social Security tax ever would. I will name those 4 at the end of this video. Plus, 3 of these 8 states were supposed to repeal their Social Security tax this year. They quietly didn't. Your state could be added to the list just as easily as it could be removed. Stay with me. Margaret, 68 years old, 31 years as a public school teacher in Minneapolis. Her Social Security was $2,400 a month. Her accountant, same guy she had used for 20 years, filed her return the way he always did. In April, she got a notice. Minnesota had taxed $18,400 of her benefits at the state level. Her bill, $1,811. She had been paying that same bill for 4 years running without knowing there was an exemption that would have zeroed it out. 4 years. Over $7,000 gone. More than her car was worth. And the fix was a single line on a form nobody told her to file. Margaret is not unusual. She is what happens when a retiree assumes Social Security is untouchable at the state level. In 42 states, that assumption is correct. In 8 states, possibly yours, it is a trap. Here's what I'm going to do in the next 12 minutes. First, I'm going to walk you through all 8 states, from the ones where you probably will not pay a single dollar, to the 2 states where retirees are getting hit hardest. Then, I'm going to show you the 3 moves that legally cut this bill to 0, even if you do not move. And I will show you the full math on a real couple so you can see exactly what this looks like. Quick disclaimer, this video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. I'm Frank Dalton. I spent 35 years as a CPA working with retirees before I started this channel. Every week on the Retirement Tax Vault, I break down the retirement tax rules that cost retirees real money, the ones your advisor does not mention because they do not generate a commission. Hit subscribe right now, turn on the bell, and let me get into it. I am going to start with the 3 states where most retirees will not owe a single dollar of state tax on their Social Security. These are the forgiving ones. Colorado. Colorado has a flat 4.4% state income tax rate, which will drop to 4% in 2026. But here's the thing most retirees do not realize. If you are 65 or older in Colorado, you can deduct all of your federally taxed Social Security from your state return. All of it. That means most retirees over 65 in Colorado pay 0 state tax on Social Security. If you are between 55 and 64, it is a little different. You can deduct up to $95,000 of your benefits if you file jointly, or $75,000 if you file single. Above those thresholds, you still get a $20,000 deduction. So even younger retirees in Colorado are mostly protected. Unless you have an unusually large Social Security benefit and you retired before 65, Colorado is not your problem. New Mexico. New Mexico is even more generous. The state does not tax your Social Security at all unless your adjusted gross income, that is, your total income, not just Social Security, is over $100,000 for single filers or $150,000 for married couples filing jointly. If you are under those thresholds, your Social Security is completely exempt. Most retirees in New Mexico are not anywhere near those numbers. This is a non-issue for the vast majority of people collecting benefits in the land of enchantment. Connecticut. Connecticut technically taxes Social Security. But in practice, if your AGI is under $75,000 as a single filer or under $100,000 filing jointly, you pay 0. Nothing. Full exemption. Even if you are above those thresholds, the state caps it. No more than 25% of your Social Security benefits can be taxed. So even a higher income retiree in Connecticut is only seeing a fraction of their benefits touched. Let me put a number on this. Say you are a single filer in Connecticut with $90,000 of AGI and $30,000 in Social Security. You are above the threshold, so 25% of your benefits, $7,500, is taxable at Connecticut's rates. Your state tax on Social Security, roughly $350 to $500. That is not nothing, but it is not the $4,800 number in the title either. Those 3 states are the mild ones. Most retirees in Colorado, New Mexico, and Connecticut will not owe a dime. Now the next 3 are Montana, Rhode Island, and Utah. That is where it starts to get real. And the last 2, that is where the $4,800 comes from. Montana, Montana has a 2-bracket income tax, 4.7% on the first chunk of income, then 5.65% on everything above that for 2026. The state follows the federal rules for determining how much of your Social Security is taxable, which means up to 85% of your benefits can be included in your state taxable income. Retirees 65 and older get a small break, a $5,500 subtraction from federal taxable income. But that is it. There is no income-based full exemption like Colorado or New Mexico offers. If you are collecting a moderate Social Security benefit in Montana and you have other income pushing you above the federal thresholds, you are paying state tax on your benefits. Period. Rhode Island. Rhode Island has a rule that catches retirees off guard more than any other state on this list. If your AGI is under $107,000 as a single filer, or under $133,750 filing jointly, and you are at full retirement age, your Social Security is fully exempt. Zero tax. But here's the trap. If you claimed Social Security before your full retirement age, which for most people right now is 67, you lose the exemption entirely. It does not matter if you only make $30,000 a year. You claimed early, Rhode Island taxes your benefits. Think about what that means. 2 neighbors, same street, same income. One waited until 67 to file. The other filed at 62 to, quote, lock it in. The one who waited pays 0 state tax on Social Security. The one who filed early pays state tax on every dollar of benefits, on the exact same income, because of a decision they made 5 years ago that nobody warned them about. That is the kind of rule that costs retirees thousands of dollars, and I have never seen a financial advisor bring it up proactively. Utah. Utah has a flat 4.55% tax rate. The state offers a credit that effectively exempts Social Security for lower income retirees, but it phases out quickly. If your AGI is above $54,000 as a single filer or $90,000 filing jointly, the credit starts disappearing. Above those thresholds, your Social Security is taxable at the full 4.55%. Utah is straightforward but aggressive. The thresholds are low compared to the other states on this list. Now here's where the numbers get serious. Everything I just covered, Montana, Rhode Island, Utah, those are moderate. The next 2 states are the reason I made this video, Minnesota and Vermont. These 2 are where retirees are losing the most money, and they are also the 2 states where the legal countermoves save the most. Minnesota. Minnesota is the single most expensive state in America for Social Security taxation, and it is not close. Here is how it works. If your AGI is under $84,490 as a single filer, or under $108,320 filing jointly, your Social Security is fully exempt. You pay nothing. But once you cross those thresholds, the exemption phases out fast. It drops by 10% for every $4,000 of additional AGI. And Minnesota's top marginal state income tax rate is 9.85%. That is the highest rate of any state that taxes Social Security. Let me run the math so you can see what this actually costs. Take a married couple, both 68, combined Social Security of $72,000. She has a pension of $40,000. He is taking $30,000 a year from an IRA. Total household AGI, $142,000. They are well above the $108,000 threshold. Their exemption is completely phased out. 85% of their Social Security, $61,200 this, is taxable at the state level. At Minnesota's blended state rate, their state tax bill on Social Security alone is roughly $4,200. Add in the federal Social Security tax on top of that, and this couple is losing over $8,000 a year between federal and state taxes on benefits they already paid into for 40 years. That is $4,200 a year at the state level. Over 20 years of retirement, that is $84,000. That is a year of assisted living. That is 4 years of property taxes on their home. Gone. Vermont. Vermont is the other one. If your AGI is under $55,000 as a single filer, or $70,000 filing jointly, your Social Security is fully exempt. Those thresholds are the lowest full exemption cutoffs of any state on this list. Above $60,000, single, or $75,000 joint, fully taxable. Vermont's top rate is 8.75%. A single retiree in Vermont with $80,000 in AGI and $28,000 in Social Security is looking at roughly $2,000 a year in state tax on benefits. Over 20 years, that is $40,000. Vermont's thresholds are so low that even a modest pension on top of Social Security can push you over the line. Now here is the part that should bother you. Everything I just described, every number, every dollar, that is just the state bill. Most retirees in these states are also getting hit by the federal Social Security tax on top of it. The 2 stack. And most people do not realize that the moves that reduce your state bill also reduce your federal bill at the same time. That is what I want to show you next. 3 legal moves. All of them are available to you right now. This is the single most powerful tool retirees have, and almost nobody uses it at the right time. Here is the idea. If you retire at 62, but you do not claim Social Security until 67 or 70, you have a window, 3 to 8 years, where your income is lower than it will ever be again. Those are your conversion years. During that window, you convert chunks of your traditional IRA or 401k into a Roth IRA. You pay income tax on the conversion? Yes. But once that money is in the Roth, it never counts toward your AGI again. It does not count toward the federal Social Security tax formula. It does not count toward your state's income threshold. It is invisible. A couple that converts $300,000 over 5 years before claiming Social Security can permanently lower their AGI enough to stay under Minnesota's $108,000 threshold or Vermont's $70,000 for the rest of their lives. That one move can save them $40,000 to $80,000 over a 20-year retirement. And the window closes the day you start collecting Social Security because your income jumps and conversions become more expensive. If you are 70 and a half or older and you give money to charity, stop writing checks. Use a qualified charitable distribution instead. A QCD lets you send money directly from your IRA to a charity. That money does not show up on your tax return as income. It satisfies your required minimum distribution, but it does not add to your AGI. If you are donating $5,000 a year to your church, your alma mater, or any qualified charity, doing it as a QCD instead of a personal check can drop your AGI by $5,000. In Minnesota, that $5,000 AGI reduction could save you $490 in state tax. In Vermont, roughly $430 every single year. On top of that, asset location. Put your bonds and high dividend investments in your Roth or tax-deferred accounts. Put your growth stocks in your taxable brokerage. Interest and dividends increase AGI. Capital gains you do not sell, do not. This is not a one-time fix. It is a permanent structural change that keeps your AGI lower every year you are retired. Moving to a no-tax state works, but it is not as simple as buying a condo in Florida and calling it done. Most states that tax Social Security use a 183-day rule. You must spend fewer than 183 days in the taxing state to break residency. But some states also look at where your driver's license is registered, where you vote, where your doctors are, where your bank is. If you keep your life in Minnesota but spend winters in Florida, Minnesota can and will argue you are still a resident. The retirees who make this work do it completely. New driver's license, new voter registration, new primary care doctor, new bank branch. They do not leave loose ends. Let me put a dollar amount on this. If you are the Minnesota couple I described, $4,200 a year in state Social Security tax plus state tax on pension and IRA income, your total state income tax bill could be $8,000 to $12,000 a year. Over 15 years, that is $120,000 to $180,000. If relocating to a no-tax state costs you $50,000 in moving and housing adjustment, you break even in 4 to 6 years and save 6 figures after that. But if you are a single retiree in Connecticut paying $400 a year in state Social Security tax, moving makes no financial sense. Do not uproot your life over $400. Use moves 1 and 2 instead. Let me bring this together with one couple so you can see the whole picture. Jim and Linda, both 67. Jim gets $28,000 a year in Social Security. Linda gets $22,000. Jim has a state pension of $35,000. Linda takes $20,000 a year from her IRA. Total household income, $105,000. Scenario 1, they live in Minnesota and do nothing. They are just under the $108,000 joint threshold, so they technically qualify for the full exemption. But here's the problem. If Jim takes an extra $5,000 from his IRA 1 year to fix the roof, they blow past the threshold. Their exemption starts phasing out. Suddenly, they owe $500 in state tax on Social Security that they were not expecting. Scenario 2, they live in Minnesota and use Roth conversions. They converted $200,000 of Jim's IRA during his early retirement years. Now his annual IRA withdrawals are Roth withdrawals. They do not count toward AGI. Their AGI drops to $85,000. They are safely under the threshold every year. State Social Security tax, 0, even the roof year. Scenario 3, they move to Florida. State income tax on everything, Social Security, pension, IRA, 0. They save not just the Social Security tax, but the full state income tax bill. But they leave their grandchildren, their church, and their community. That is a personal decision, not a financial one. The point is this: moving is one option. It is not the only option. And for most retirees, the Roth conversion strategy and QCD strategy together can save 80% of what moving would save without packing a single box. Let me bring it all together. 8 states. Here they are, from mildest to most aggressive. 1. Colorado. Most retirees over 65 are fully exempt. not your problem. 2. New Mexico, exempt under 100,000 single, 150,000 joint. Most retirees pay 0. 3. Connecticut, exempt under 75,000 single, 100,000 joint. Even above, capped at 25% of benefits. 4. Montana follows federal taxability rules, small subtraction for seniors. Moderate hit, 5. Utah, flat, 4.55%. Credit phases out above 54,000 single, 90,000 joint. 6. Rhode Island, fully exempt if you waited until full retirement age and are under income limits. Claimed early, you pay. 7. Vermont, thresholds start at 55,000 single, 70,000 joint. Low cutoffs, high rates, expensive. 8. Minnesota, 9.85% top rate. The most expensive state in America for Social Security tax. And the 4 states I promised you at the beginning, the ones that do not tax Social Security but hammer your retirement income anyway: California, Oregon, New Jersey, and Hawaii. All 4 tax 401k withdrawals, pensions, and IRA distributions at high rates. That is a full breakdown for another video. It is coming. This is Frank Dalton, the Retirement Tax Vault. If this video helped you see a number you did not see before, hit the like button right now. It takes 1 second and it pushes this video to more retirees who are paying a bill they do not know they can cut.